into this week's episode of Policy and Profits. I'm Anthony Esposito, founder and CEO of Ascalon 6 Capital. I am here with my good friend EJ Antoni, head economist at the Heritage Foundation. EJ, how are you, my friend? How's the week going? I know the answer, but I'm going to ask anyway.
Another crazy busy week. It's just fascinating to be watching the markets right now, especially in the timing with all these different data releases, the moves going on at the Fed, what people are expecting to happen with the balance sheet, and just basically trying to connect the dots and figure out how on earth do we have all these inputs and we're getting the output we are with the market, which is really incredible.
Yeah, the market's been really interesting. I mean, along those lines, the individual name vol and the index vol has diverged the widest in history. We have massive noise underneath the cover, and then you look at the S&P and you're like, oh, it's a pretty quiet day. We're only down, 2.5% from the top. So there's definitely a lot going on. There's some action that I don't quite understand. I haven't been able to figure out why things are so different this time around. I have some theories, but we'll maybe talk about those in a minute. Part of what everyone's focused on, and there's a lot, but part of what everyone is focused on is inflation. You had a great post this week. We have that cut of the national debt. National debt now at $39.6 trillion. We can take a look at that cut and see the line is literally parabolic. We talked last week about the national debt actually being a large part of why we have such bad inflation. And there's policy involved and there's price shocks involved, but the national debt, the printing of money, the overspending, the money supply generation and liquidity is really at the core of it. Could you please go into exactly how catastrophic this is and what effect it'll have on rates and how we get this back in line? Because it looks to me like there's no way to pull this back in except for, I mean, if it was a stock, I'd be looking for a really hard snap down, which I know we can't get.
Right. Yeah. And correct me if I'm wrong, Anthony, but I think we saw the 2 and the 10-year yield setting new highs for the year, right?
We
For
did.
2026
We
today.
did. That's actually our next cut after this. We definitely did. The market is taking over for war. He doesn't have to worry about raising rates. The market's raising them for him.
Exactly. Right. Right.
It's
Exactly.
going to happen.
Yeah, I mean, basically, you got to realize the government's the biggest borrower there is, right? The U.S. federal government, and you got to think of the loanable funds market in terms of supply and demand when we're talking about interest rates, because the interest rate is just the price for loanable funds. So if you have this huge increase in demand for loanable funds, right, what's going to happen to price? It's going to go up. And I think if you think of it in those terms, instead of the way people typically think about it, where they reverse supply and demand because they're looking at things like treasury auctions.
Mhm.
It's not, why is it when the treasury why is it when the treasury is offering so much more in terms of bonds that yield goes the way it does? People think that, oh, well, you're increasing the supply of bonds, right? Shouldn't you see prices come down? You're confusing prices between different markets, right? Prices of bonds versus the price to borrow money, different things. And basically what we're seeing here is because the federal government just won't stop borrowing. I think before February, we were on a good path. Now we're just not. Unfortunately, a lot of that has to do with the war in Iran and all the additional money we're going to have to spend just on that, plus the money we're going to have to spend because of the fallout from the war. So we're not slowing down. As some people like to say about the national debt, there's just no brakes on this freight train. And sadly, that seems to be the case. All right. So with that in mind, you have this huge increase in demand for loanable funds. What's going to happen to price? It's going to go up. The price of loanable funds, again, that's the interest rate. And this is why you have a 30-year yield that is stubbornly over 5% and just won't come down.
Yep.
I think this is the longest number of consecutive trading days going. You have to go back to the global financial crisis to find a period when you had a shorter run of the 30-year at 5%.
Yep.
It's not
5181 was today's high. 5.181 closed at 5163. So it's significant. 10-year closed at 4695. 4301 was the high today. And note the 44 level was the taco level. I hate the term, but that was the level that President Trump, it was suspected that every time we got the 10-year to 4.4, he would come in and diffuse. And that was one of the inputs. There were actually a couple of brokers who built kind of reversal models. and or reversion models from Tactic, and one of their inputs was the 10-year yield at greater than 4.4%, and then there were a couple of other things where it was expected that President Trump would come in and diffuse whatever was going on, whether it was tariffs, whether it was Iran. We've blown through that number now, so the yields are definitely off to the races. There's zero question.
Yeah, so you have to think, okay, if you have what is very shortly going to be $40 trillion in debt, right? I mean,
Yeah.
we are literally just weeks away from that. $40 trillion in debt, and then you have yields converging on, let's say, 5%. If you look at the whole, whether it's the short term, you got the
Yeah.
bills on the one end and then the bonds, the 20 and the 30 year on the other. So let's say you average it all out, you're converging on about 5%. I mean, do the math. That kind of interest is going to break the back of, you're looking at $2 trillion plus. I mean, that's not sustainable. We're already, for this fiscal year at least, which is, we're coming up on the end of it soon, but we'll probably break $1.3 trillion just in interest. I mean, how is it anybody thinks rates can come down in that environment? They just can't.
No, they can't. They can't. We have the second cut was actually the rate sheet that I had up from last night after
Hmm.
the close. So these are a little stale, but you can see that convergence on 5%. The top block is these are U.S. bonds, 2 years to 30 years, and you can see that a 4.298 as of last night to a 5.145. Break evens at 2.283, 2.264 today. So there's no way for rates to come down. The market won't allow rates to come down. Um, I think the next question is what happens with Warsh as far as the balance sheet. Does he start to? You need to pull liquidity out of the system, and now, especially with and you talked about this a couple of weeks ago. We talked about it on the show. If there was a re-escalation in the Mideast, I think we can say there is. The Strait, I think, had two ships pass today, down from, I got to look at the number again, but down from about 160 on average pre-war. Um, so the Strait is closed, supply chain is destroyed. They're very disrupted. Um, what do they do about inflation here? He's does he rate does it even matter if he raises the Fed funds rate, or does he start working off the balance sheet and selling off assets to try and pull liquidity out of the system, or does he sit put and just kind of watch and communicate less but act less?
I think honestly they just stand pat for the
Yeah.
rest of the year is most likely. Obviously, a lot can happen between now and December, so we'll see. But increasingly, they don't have room to cut rates, not because of what's going on in oil, but because of what's going on with the national debt. I think probably a majority of FOMC members are actually going to look past the oil shock. You might think that's right, you might think that's wrong, but I think that's
Okay.
probably what's going to happen. Um, but the underlying just basic mechanics here of what's going on with the loanable funds market, I think, is telling them they can't cut rates right now. They just can't,
Yeah.
unfortunately. And I don't think they're likely to hike rates either, though. So
Mhm.
that's why I say most likely probably that they just stand pat here. Um, it's and the other thing I think we got to look at too, Anthony, when we talk about the re-escalation here. Now you're worried about the Houthis, I think it is,
Yep.
and other groups, different proxies of Iran,
Yeah.
who are talking about potentially firing on ships in an attempt to close the Red Sea. So not
Yeah.
not the Persian Gulf here, but the other end of the Arabian Peninsula.
Yeah.
And the reason that's such a big deal is you have nations that were, even before the conflict, were already shipping oil out through the Red Sea. But on top of that, a nation like Saudi Arabia used their transnational pipeline to transfer something like 40% of the oil that previously was going out on the East Coast, which was the Persian Gulf,
Yeah.
has been going out the West Coast, the Red Sea. So now you're talking about one of those lifelines potentially getting cut off if you can have disruptions out of that waterway as well. I mean, that would be pretty devastating too. So it's not just a re-escalation in terms of, okay, we're back where we were. I think we actually might be in a worse place than we were previously, looking
Yeah.
at the potential here for those supply chain disruptions.
Well, look, the Houthis hit two ships last night. I was actually trading the overnight and the futures. That was the big story last night, along with the Google report and the Tesla report, they were getting whacked and got hurt pretty badly today. Um, they're definitely looking to take control of those two straits. As far as anyone could argue, they have control of those two straits, one way or the other. The straits are closed down, and they're in control of it. So I think I would argue that we're in a worse spot now than we were initially, and I think that for the president and for the U.S., we need to make a decision on pretty immediately what we're going to do to end this conflict and to get to the resolution we want. We just can't continue to kick the can down the road because they're not negotiating from a place of trying to end it. We know that they are fighting a holy war. They'll die on the line, and we want nuclear weapons removed from them, and we want them shut down, essentially. So we're going to have to figure that out. And as of right now, I would say we're not doing a fantastic job. If in optics only, we're not doing a fantastic job of shutting this down and getting it done. So uh, there's definitely been some escalation there on both fronts. I think it's the markets are starting to recognize it. There is a phantom bid somewhere in the market. I don't know where it's coming from. I have some thoughts. But as we came through the open this morning, we had a big rip up. Futures were down 1.2% on the S&P heading into the cash open. Cash open in the S&P, in the Russell, and actually in gold as well. We had a massive buy program spike, all three contracts, gold, more importantly, S&P and Russell, a big spike up and then a fade down to the lows. And then the end of the day came in with a big spike up again. So a lot of volatility in the markets, obviously downward pressure, and it's getting heavy. And if we don't get an end to this escalation and some resolution there, it's going to be bad for the markets. It's going to get much worse for the markets. I don't see how we hold. We've broken through major support and supportive patterns on the NASDAQ, on the S&P, on the Russell. The weekly charts look horrible. The daily charts look horrible. They have for some time. I actually don't know how the S&P is as high as it is, but next time we get next show, we'll go into some charting and we'll pull back the charts up and see where we're at. One thing that's also weighing on the markets, EJ, and I wanted to get your take on this as well, is the amount of debt that the hyperscalers are taking on and the amount of debt that's being generated as we talk about sovereign debt, which across the globe is out of control. It's not just the U.S., which is concerning. The amount of debt that's being issued by the hyperscalers and in this AI kind of ecosystem. So I saw an article, it's cut three, which was pretty interesting to me. It was out of the Nikkei Asia. 5 U.S. tech giants, hidden debt soars to 1.65 trillion on opaque AI funding. So I'm going to pause there for a second and just give you two stats, which I think are really interesting before we head into this. The first stat is SpaceX debt is now trading at junk levels. That's the first one. I'll say that again. SpaceX debt is trading at junk. It was below 90. And 7 of the top 10 shorted investment grade debt, 7 of the top 10 shorted investment grade debt are hyperscalers at this point. So the debt is not functioning properly. There are red flags everywhere in the debt market. Yet the equities market, although there's a lot of noise in these names, I'm not saying there's not. I mean, Tesla today was down 14%. Google was down 8%. They're way off the highs. If you look at the Mag 7 ETF, it is broken and gapping down. I'm not saying that they're not showing signs of weakness. What I'm saying is overall, if these names fail, the S&P can't possibly continue to run up. Between the chip makers and the Mag 7, that's 55% of the S&P 500 at this point by market weight. So it can't functionally keep going higher. The broadening story, I think, is incorrect. And if you see the debt markets raising the red flag, then you need to be aware of that on the equity side. So they've issued hundreds of billions of dollars of debt already. Google's come out and said they were going to actually issue equity, which was not received well initially. They're issuing debt not only in the U.S., but in Europe and Asia. It's a broad stroke. Now what we're seeing is, and we can go to slide 7, we're seeing that they actually are hiding some of the debt that's being issued. So I really want your take on this and how this even functions. We have the hyperscalers and NVIDIA on balance sheet making lease or purchase agreements to the suppliers. Those suppliers are using those agreements as credit with the banks and credit unions, and they're taking out loans against those commitments, future commitments for business. So we have this purchase agreement kind of fake balance sheet. I don't want to say fake balance sheet, but it is. I have to be really honest with you. It's reminiscent to me of Enron. And
Hmm.
now, and the fall, for those of you as old as I am, I was there the day that of the IPO, and I was there the day that it went to zero. Um, I actually shorted a ton of it on the IPO day, which was very unheard of for a very a very well known hedge fund manager, which I won't name, but he made a lot of money on that trade. Uh, could you explain to me, as we look at this kind of balance sheet finagling,
Hmm.
is there any way this is not? I don't know how to say this. Not is there any way it's not going to blow up? But how dangerous is this when we see 1.6 trillion on top of the other debt now issued on future commitments used as collateral? Am I missing something here?
No, Anthony, I don't think it's that you're missing something. I think it's that, look, debt is leverage and leverage is risk. So it's one of those things where, look, as long as as long as all the dials line up perfectly, as long as the machine keeps going,
Yeah.
theoretically, this is fine,
Hmm.
right? Theoretically, everything's going to be okay. It's like those folks who say, all right, I'm going to uh, borrow a bunch of money to buy an investment property, and then I'm going to, after a little bit of time, take out all the equity and use that as the down payment on another investment property. And then you keep going with this daisy chain and you just lever up like crazy. And look, theoretically, as long as home price appreciation continues at the pace you thought it was going to, as long as your renters pay on time, as long as you don't have a lot of unforeseen expenses like new roofs or new water heaters, new air conditioners, you name it, right?
Yeah.
As long as things go the way you thought they would, if everything goes according to plan, then yeah, you can make money with that. In fact, you can make more money doing that than you could with other things, right? But that's not your risk adjusted rate of return. That just happens to be your rate of return when everything goes really well. That seems to me a lot like what this is. You're taking these future commitments, as you mentioned it, and you're basically trading it like it's currency. And if
Yeah.
you're not properly discounting it, or I should say, if the lender is not properly discounting it, the lender's going to lend you too much money.
Yeah.
And that's very likely, I think, what we have seen and what we continue to see in these markets. And this is where I get so anxious, frankly, about what's happening right now with oil. Brent was over 90 today, right? If I
Yeah.
remember
Yeah.
correctly.
Yeah.
Um, all these different AI firms, energy, as far as I understand it, is their biggest input. Not
Mhm.
necessarily in terms of initial investment, because you got to buy all the chips
Yeah.
and everything, right? You got to buy the racks, as they call them. But to run the business, your single biggest cost, far and away, electricity. It's
Yeah.
energy.
Yeah.
Well, energy prices are going through the roof right
Yeah.
now.
Brent, by the way, over par, 100.61.
Like who on earth, in terms of all these hyperscalers, had $100 oil in their forecasts? I'll give you a hint. None of them.
Yeah.
Nobody. So now these high energy prices are throwing off all of the calculations of these businesses. And I think it's a
Mhm.
big reason why, if you look at on January 1 of this year, all of the data centers that were either under construction or at least planned, only half of them are either now still planned or under construction or even completed.
Yeah.
So half of what was either planned or had already been started construction got canceled between January 1 and today.
Yeah.
I
Yeah.
mean, that's again, it gives me a lot of anxiety looking at the kinds of models on which all of this growth, quote unquote, has been based.
Yeah. No, I agree with you 100%. I'm actually looking over just as a reminder. Um, the Where are we here? Give me 1 second, because we talked about Intel 2 weeks ago. Intel reported stock is up 6.4% at 100 spot two, 109 spot two, 109.20. The PE is at a very, very lofty 399. That's 399. Okay.
Oh my goodness.
I don't know. I don't know what we're doing or what we're looking at. I don't know why people would be digging into this thing with a PE at 400. I don't. I'm a technical analyst. I'm a CMT. I'm
Yeah.
trend momentum, but I'm certainly old enough to remember valuations being the Schiller PE above 40 at 44 and 99 2000, and everyone saying it's different this time. And I'm looking at the Schiller PE right now, just about at 44. Only 2 times in history we've been above 40, and people are making every excuse as to why it's different this time. So I definitely have trouble sleeping at night, as well as you clearly do. I think the point here is to just kind of bring up some of the things that people are not talking about, and just raise some cautionary flags. We are definitely in a period where the market is supported by a bid, and I believe that's a structural bid. I don't believe that's a fundamental bid. I don't believe it's a real bid. That doesn't mean that that bid won't support and push the market higher. It has. It has for multiple percentage points here. I just think that as we look at things like the national debt, as you start to highlight where rates are going, what the Fed balance sheet looks like, what the national debt looks like, what we're spending every year on servicing that debt. We look at the hyperscalers, the spending, the debt creation, the equity bubble. We just want to highlight that there is reason to be extremely, extremely concerned at these levels. So, EJ, as always, I appreciate the insight. You do a great job with this, man. At real EJ Antoni on X, I'm on it every single day. The charting is great. The analysis is great. Greatly appreciated. I look forward to speaking with you next time, my friend, and I look forward to seeing you soon for a steak and a bourbon at our earliest possible meeting time. Thank you, buddy.
Sounds like a plan, my man. Till next week.